Welcome to today's video, where I'm going to help you determine the optimal allocation of real estate in your investment portfolio for long-term growth and stability. We'll dive into the benefits of real estate investments, factors to consider when allocating your portfolio, different investment options, and striking the right balance between real estate and other asset classes. So stay tuned to learn how to build a resilient and high-performing portfolio. Including real estate in your portfolio offers several key benefits, which contribute to a well-rounded and robust investment strategy. One of those many benefits is diversification. First, it offers a tangible asset that is different from traditional investments like stocks and bonds. This means that real estate returns may not move in the same direction or at the same rate as those other asset classes. For example, during a stock market downturn, real estate prices may not necessarily decline in tandem. Second, real estate investing offers the opportunity to invest in a variety of property types, such as commercial, residential, industrial, and even specialized properties like mobile home parks. This allows investors to diversify their portfolio across different real estate sectors and avoid concentration in a single property type. Third, real estate investments offer the potential for income from rental properties, which can provide a stable, ongoing stream of cash flow. This income can serve as a source of diversification from traditional investments, which may not offer regular income payments. Another key benefit is income generation. Rental properties and private real estate funds can provide a steady cash flow through rental income and dividends, giving you a reliable source of passive income to support your financial goals. In a nutshell, when an investor purchases a rental property, they can collect rental income from tenants on a monthly basis. The rental income is typically higher than that of the mortgage payment and other expenses, such as property taxes and maintenance costs, allowing the investor to generate positive cash flow. In some cases, investors may be able to also increase the rental income over time by making improvements to the property or raising rents. This steady stream of rental income can provide a reliable and consistent source of cash flow for the investor. Additionally, when the property is eventually sold, the investor may also realize capital gains from any appreciation in the property's value. Another benefit is appreciation potential. Over time, real estate values tend to increase, providing potential capital gains that can add to your overall net worth. For example, let's say that you purchase a property for $200,000. Over the next 5 years, the value of that property increases to $250,000 due to factors such as improvements made to the property, an increase in demand in the area, or just general market appreciation. This means that that property has appreciated by $50,000 or 25% during the 5-year period. If you decide to sell the property at this point, you would earn a $50,000 profit on your initial investment of $200,000. This represents a 25% return on your investment. Another massive benefit are the tax advantages. Real estate investments offer various tax benefits such as deductions for mortgage interest, property taxes, and depreciation, all which can help reduce your overall tax burden. Depreciation is a particularly appealing advantage for investors. Here's how it works. Depreciation is a non-cash expense that allows real estate investors to deduct a portion of the cost of their investment property over a certain number of years. For example, if an investor purchased a rental property for $300,000 and the land value is assessed at $50,000, the investor can depreciate the remaining $250,000 over 27.5 years. This would result in an annual depreciation deduction of $9,091, or simple math is $250,000 divided by 27.5 years. The depreciation deduction reduces the taxable income generated by the property, which can then result in a lower tax liability for the investor. When deciding how much real estate to include in your portfolio, it's essential to consider several factors that influence the optimal allocation. These factors include things such as financial goals. You need to start by outlining your financial goals, such as generating passive income, building long-term wealth, or diversifying your investment portfolio. This will help you determine which types of passive real estate investments align with your objectives. You need to consider your investment horizon. Consider the time frame for your investment. If you have a longer investment horizon, you may be able to tolerate more risk and invest in properties with higher growth potential. On the other hand, if your investment horizon is shorter, you may prefer more stable and conservative investments. Another thing is risk tolerance. You need to evaluate your tolerance for risk, which is your ability to withstand fluctuations in your investment's value. Factors like your financial stability, age, and investment experience can all influence your risk tolerance. An investor with a higher risk tolerance may be more comfortable with investments that have a greater potential for both gains and losses, while a conservative investor may prefer lower risk investments with more predictable returns. Diversification can help reduce the overall risk of your investment portfolio. As a passive real estate investor, consider investing in different types of properties, locations, or real estate investment vehicles such as real estate investment trusts, also known as REITs, crowdfunded real estate platforms, or real estate mutual funds. Understand the historical performance. You need to research the historical performance of various passive real estate investment options to gain a better understanding of their risk and return profiles. This can help you select investments that best align with your risk tolerance and financial goals. There are various ways to invest in real estate, catering to different investment styles and objectives. Some of the most popular options include direct property ownership. And this means that you personally are buying residential or commercial properties to rent or to resell, which allows you to generate income and potentially benefit from property appreciation. One of the key benefits direct property ownership provides is control. As the owner, you have complete control over the property, including its management, rental rates, the tenant selection, and overall maintenance. This level of control allows investors to make decisions that can maximize the property's value and cash flow potential. Another option are real estate investment trusts, investing in publicly traded companies that own income-producing properties. This option provides an accessible and liquid way to gain exposure to the real estate market without the hassle of direct property ownership. Another option are real estate funds and syndications. Real estate funds and syndications allow you the opportunity to pool your money with other investors to acquire larger properties or a larger diversified portfolio. This approach enables you to access higher value investments and spread your risk across multiple assets. A few of the key benefits of real estate funds and syndication are that, first and foremost, you get access to institutional quality assets. Real estate funds and syndications pool the capital of multiple investors to purchase larger, high-quality properties that would be difficult or nearly impossible for an individual investor to acquire. They also offer diversification. Real estate funds and syndications offer exposure to a diversified portfolio of properties, which can help reduce investment risk. Real estate funds and syndications are typically managed by experienced real estate professionals who have the knowledge and expertise to identify and manage properties that are likely to produce strong returns. Real estate funds and syndications often target higher returns than traditional REITs or other passive real estate investments. Similar to direct property ownership, investors in real estate funds and syndications may be able to take advantage of tax benefits, such as depreciation and interest deductions. Real estate funds and syndications may also offer flexible investment options, allowing investors to choose between debt or equity investments and providing options for short-term or long-term investments. In order to maintain a well-balanced portfolio, many investors allocate their assets among different classes. In addition to real estate, these folks will diversify into assets like stocks and bonds. The ideal allocation will of course be varied based on your individual financial goals, risk tolerance, and investment horizon. Financial advisors often recommend allocating between 10% and 30% of your portfolio to real estate, with the remainder distributed among other asset classes to create a diversified and resilient investment strategy. It's essential to regularly review your portfolio to ensure that it remains aligned with your financial goals and risk tolerance. As market conditions change, your asset allocation may shift, requiring adjustments to maintain an optimal balance. Determining the optimal allocation of real estate in your investment portfolio is essential for long-term success. By considering factors such as risk tolerance, investment horizon, and diversification needs, you can create a balanced portfolio that helps you achieve your financial goals. As you continue on your investment journey, consider seeking professional guidance to help you navigate the complexities of portfolio management and real estate investing. And remember, staying informed and proactive in managing your portfolio is crucial for long-term success. Don't forget to like, share, and subscribe for more valuable investing insights. And leave a comment below with your thoughts on real estate allocation, and don't forget to check out the free guide in the description. We're always eager to hear from our community and learn more from your experiences. Thanks for watching, and I'll see you in the next episode.